Hello everyone, this is Sunko, the Korean bro. Today is 2023, August 22nd. Okay, let's start looking at stock market. Okay. Warren Buffett just dumped these three dividend stocks. Should you? U2 and Universal Music Group teamed up to manage the music together. Here's what investors should know. Things that bear and bull, better buy. Mobile Eye, Wolf Speed. Okay. Warren Buffett just dumped these three dividend stocks. Should you? Berkshire Hathaway exits petition Mackinson, Marsh and McLennan, and VTC Energy in quarter second. YouTube and Universal Music Group teamed up to manage the music industry's AI challenge together. Here's what investors should know. Generative AI is revolutionizing the music industry by creating melodies and lyrics and even mimicking legendary voices. YouTube and Universal Music Group have formed a partnership to manage AI generated music on YouTube's platform. The AI Management Foundation developed by this collaboration could benefit could benefit the entire music sector well beyond YouTube. How AI is shaking up the music business. Artificial intelligence is shaking up many industries these days. The music business is no exception. AI tools can already write melodies and song lyrics. They're also bringing back the singing voices of long deceased artists such as Frank Sinatra and John Lennon in new songs. Facing the AI challenges aid on Alphabet and subsidiary YouTube has partnered up with the music publishing giant Universal Music Group. Together, the companies have set up policies for publishing AI generated music on YouTube's music streaming platform. Artificial intelligence has been around for decades, but the recent rise of generative AI has suddenly shifted the long-term trend into overdrive. Generated AI tools such as JetGPT and Jukebox can create new material based on their deep learning analysis of many original works. An artist or producer could make a whole song out of nothing but AI generated lyrics, melodies, and backing tracks. And to top it off, other AI systems can analyze the voice in many samples from the same person and then apply that vocal style to another singer's performance. With the help of generative AI, musicians and producers can do a whole bunch of formerly unheard of things. While it's fantastic to have new tools for expressing human creativity, the machine powered aspect of the AI toolkit raises uncomfortable questions. Above all, who should own the rights to machine generated tune? You know? These abilities are opening up several cans of worms, both legal and ethical. That's why Universal Music and YouTube are in a new group together right now. As a leading music publisher, Universal wants to make sure the company and its artists get compensated for their creative works. YouTube Music is one of the largest music streaming platforms on market today. Many of the most popular videos in the core YouTube service are music videos. So the company has incentives to keep the music market flowing and lucrative. and we will embrace it responsibly together with our music partners. AI is ushering a new age of creative expression, but it must include appropriate protections and unlock opportunities for music partners who decide to participate. We've built in an industry-leading trust and safety organization and content policies will scale those to meet the challenges of AI. Mobileye and Wolfspeed. What are they? Mobileye Global and Wolfspeed represent two different ways to invest in the development of electric connected driverless vehicles. Hmm. Mobileye is the world's leading developer of advanced driver assistance systems, which help drivers park their cars, stay in the right lane, and use adaptive cruise control features. These systems are powered by its own IQ computer vision chips. Wolfspeed uh, is the world's leading manufacturer of silicon carbide higher voltages, temperatures, and frequencies than traditional silicon chips. The resilience makes them well suited for short length LEDs, lasers, 5G based solutions, stations, and military radars. Wolfspeed also sells silicon carbide materials to electrical vehicle makers for the production of batteries and powertrains. One analyst is contest to stop one of his best investment ideas. The analyst price target implies about 30% upside for the growth stock over the next 12 months. Hmm. The Cybertruck is one of several major catalysts on the horizon for Tesla. The electric car maker has three major growth drivers in the works that could propel shares substantially higher over the next 12 months. Shares of Tesla surged on Monday, rising more than 7%. The growth stock's gain may have been driven in part by an upbeat day for the S&P 500 and tech having also composite. But shares likely also benefited from a bullish analyst note. Bear analyst Ben Keller put Tesla on his best ideas this week, citing a range of catalysts for his stock that could help shares hit his 12-month price target of $300. Could Tesla shares really rise about 30% higher over the next 12 months? To assess whether this is plausible, let's examine why Keller is so bullish on electric car maker shares. The analyst listed a handful of catalysts for Tesla stock. Here are three that may be the most important. Mm. Cybertruck. Perhaps the most important catalyst for Tesla stock that Keller printed to is the company's long-awaited hello uni. Okay. I get it. I'm gonna take your selfie. Boop, and then boop. Okay. I'm gonna take a selfie. Ooh. Ooh. Dee, dee. Okay. Okay. I was talking about Cybertruck. Yes, yes, yes. Hmm. Okay. Perhaps the most important catalyst for my love you. The most important catalyst for Tesla stock that Kellogg pointed to is the company's long-awaited Cybertruck. It's difficult to overstate the impact the all-electric truck could have on Tesla's business. Tesla CEO Elon Musk has said on several occasions that the company will start deliveries of a new vehicle this year. The three best-selling vehicles in the U.S. last year were pickup trucks. Ford F-Series truck deliveries alone came in at more than 650,000 units. Tesla delivered less than 500,000 vehicles globally. In its most recent quarter, so the Cybertruck will substantially expand its addressable market. Unsurprisingly, demand for the all-electric truck is huge. Demand is so far off the hook you can even see the hook. But said in the company's second quarter earnings call. And we got driver assistance software. Another key catalyst side is an expectation for continued adoption of Tesla's full self-driving driver assistance software. Tesla expects the software to enable autonomous driving eventually. For now, however, it's simply glorified driver assistance technology, albeit it's a top-notch tech that's able to read and respond to stoplights, stop signs, and even complex situations like traffic circles. Available for purchase for $15,000 offering or for a monthly subscription. The wildly pricey software is growing in popularity. With Tesla's drivers, the better the software gets, the more adoption it will likely see. Though Tesla CEO Elon Musk is known for being overly confident in his forecast, he indicated in the company's second quarter earnings call that these are early days for the beta software. FSD beta has already been utilized across its fleet for over 300 million miles, explained. But this number is going to seem small very quickly, he said. It will soon be billions of miles, tens of billions of miles indeed. He says that Tesla now sees a clear path to full self-driving, being 10 times safer than the average human driver. Clear path to full self-driving, being 10 times safer than the average human driver. Tesla Energy. Finally, there's a Tesla Energy business, which consists of energy storage products and solar solutions. The business may be small today at about 7% of second quarter revenue, but it's growing at an incredible rate. Tesla's energy generation and storage revenue rose 74% year over year in quarter second to more than $1.5 billion. Further, energy storage deployments measured by gigawatt hours increased 222% year over year during the quarter. As this business grows as a percentage of total revenue, investors will likely start paying more attention, and the market may ultimately assign it a greater value. But there are certainly some good reasons for Tesla stock to potentially rise to $300 within 12 months. There are a lot of risks too. Valuation is one of them. Trading at 75 times earnings, the stock is already priced for strong growth in both revenue and earnings. Therefore might want to wait to see if they get an opportunity to buy the stock at a lower price, particularly following the stock's big jump on Monday. On the other hand, catalysts for the stock are piling up. Investors therefore may want to take some time to look more closely at the stock to see whether catalyst buy recommendation makes sense for them. Mm. Okay, let's see. Billionaire short-term investor Kevin O'Leary says Michael Burry's bearish bet on the S&P 500 is very risky. Made a big bet against S&P 500 and also 100. Kevin O'Leary questioned Burry's move in a Fox News interview last week. Burry's bearish bet. Burry's CEO and asset management revealed last week via regular filings that he bought put options for the SPDR and S&P 500 ETF. Truth An exchange traded fund that tracks the S&P 500. Sion also bought put options for Invesco QQQ Trust Series 1 ETF, which tracks the NASDAQ 100 index. Sion's 13 affiliate listed the combined value of these put options is close to $1.8 billion. The hash fund still owns positions close to 30 stocks. However, Burry's SPY and QQQ puts appear to be more than simply a hash that would provide a cushion for the rest of Sion's portfolio. Burry has been vocal about stock valuations for a while. In June 2021, he tweeted that the market was experiencing the greatest speculative bubble of all time in all things. The S&P 500 and NASDAQ 100 went on to plunge the next year. However, both indexes are now higher than they were when Burry issued his dire warning. Okay, O'Leary, though, expressed skepticism of Burry's latest big bag into the stock market. He told Fox News last week that Burry could be in store for some pain. The short source said people that try to leave off market timing have a very hard time. Acknowledge that Burry will be right one day, that the S&P 500 will fall, but there's no way to know when the day will come. You know? Hmm. Hmm. Let's. What does it say about DocuSign? DocuSign. It's been a while, right? So, uh, okay. Let's go with Meta platforms first, and we'll move on to next one. Okay. Okay. Anyway. Hmm. First, Meta platforms. Meta platforms could use artificial intelligence to create enormous value. Owns leading social media platforms, Facebook, Instagram, WhatsApp, and the Threads. The company is no stronger to the $1 trillion club. It was a member back in 2021 before it got bogged down in cash burning projects like the metaverse. By late 2022, investors had slashed its valuation by 76% from peak to trough. But Meta has bounced back with a vengeance. The stock has soared 127% in 2023 on the back of the company's commitment to cost cuts and its use of artificial intelligence to reignite growth. Its short form video feature Reels is at the heart of its combat. It's designated. It's designed to compete with ByteDance's TikTok, which has dominated the attention of younger users over the last few years. Meta is using AI to predict the type of content users want to watch. And it's then feeding them more of it to increase engagement. In the second quarter, its AI discovery engine was credited with a 7% increase in the time users spent on Facebook compared to a year ago. The company already cited technology's response for a 24% increase in time spent on Instagram since Reels was launched. So, Meta is also using AI to serve advertisers on its social media platform. It introduced generative AI tools capable of creating text and crop image, produce more effective ads. It offers AI-powered predictive analytics to help business understand how ads might perform. Meta's revenue and earnings have now returned to growth, much to the delight of investors who collectively value the company at $728 billion right now. Wall Street expects it to deliver $12.32 in the full year earnings per share in 2023, and based on its current stock price of $283.25, trades at a forward price earnings ratio of 23. Okay. So the point here that he makes is, Although Meta platforms had a hard time a few months ago, you know, um, they have their place back with Reels, uh, and it's generative AI. Okay. Mm, okay, three smart. Let's see. Let's read this one. Okay, let's see. Four reasons Zoom video is ready to rock into a reversal. Zoom video communication is ready to reverse course and trend higher. The quarter second results and guidance are favorable and should lead the analysts to raise their targets. Institutions that bought in 2023 and put a bottom in the market. There are several reasons why Zoom video communication is ready to rock into a reversal. The point is that stock is down more than 87% off its pandemically driven highs and offering an opportunity that long-term investors may not want to pass up. With growth on the table, the stock is at a turning point ready to begin trading higher. The question is when the rally will start. Based on evidence in the analyst and institutional activity, the rally could start sooner rather than later. Given the slowdown in work at home activities, Zoom video communication was not expected to have a rubbish quarter, so it was expected to post solid quarterly related to last year. And the reality is that the underlying business is stronger than anticipated. The $1.14 billion in net revenue is up 3.6% compared to last year. Okay. Let's look at some of the info about. Let's see. Hmm. Not data dog, but uh, okay. Let's go see about DocuSign. Okay, on DocuSign. There you go, DocuSign. Okay. Growth slowed down significantly after the pandemic. Dropbox still faces stiff competition from larger cloud storage services. Now let's go see about Docu. What happened to DocuSign? DocuSign's revenue rose 49% in fiscal 2021 as the pandemic drove more companies to use its e-signature services and grew another 45% in fiscal 2022. But in fiscal 2023, its revenue only rose 19% to $2.4 billion as the pandemic passed and inflation, rising interest rates, and other macro headwinds throttled its growth. Competition from other similar services, including Adobe Sign, which is integrated with Acrobat, and Dropbox's Sign, which is bundled with its other cloud services, likely exacerbated the slowdown. Okay, DocuSign doesn't expect those headwinds to dissipate anytime soon. For fiscal 2024, expect its billings to only rise 3% to 4%, as its total revenue grows 8%. Analysts expect its revenue to rise 8% this year and 7% in fiscal 2025. To stabilize its business amid a slowdown, DocuSign laid off 9% of its workforce last year, another 10% of its remaining employees earlier this year. That's why I expect its adjusted operating margin to expect from 21% to 24% in fiscal 2024, even as it rolls out newer features like easy to create web forms for gathering online data, more sophisticated ID verification tools, integrations with electronic health record in the United States, and generative AI summarizes of a longer contract. Analysts expect adjusted EPS to grow 26% this year, rise 5% in fiscal 2025. Those growth rates are decent, and stock seems reasonably valued at 21 times forward earnings, 4 times this year. But it probably won't win back this growth investors who fell in love with the stock during the pandemic. I show with DocuSign because it's a market leader with a more defensible niche. It faces milder competitive headwinds and it's growing faster. Europe still needs to prove it stand out in the crowded cloud storage services market without crushing its own margins. Okay, let's read the one last one and then I'm done with it. Let's go see about not Palantir, but what else we have? Hmm. Not Palantir. Oh. Mm, okay, let's go read about Block. Okay, Block operates two successful ecosystems. Coinbase is poised to gain one as crypto market recovers. Okay, let's go. Block is a fintech leader that serves both small merchant and individual consumers. A gross profit of $1.9 billion in the second quarter was up 27% year over year. That slowed down from a gains posted in prior years, but it's still healthy growth given the uncertain macroeconomic environment. On the merchant side, Square offers a suite of hardware, software, financial services that only allow retailers to accept card payments. Suite of hardware, software, and financial services, and not only allow retailers to accept card payments, but complete a wide range of tasks to help them run their business more seamlessly. One of the key trends lately is Square's popularity with larger merchants, a positive development because it lead to lower cyclicality in gross payment volume. It might be more common with smaller and more economically sensitive merchants. Hmm. Okay, consumers have flocked into Cash App, a personal finance tool with 54 million monthly active users. Cash App is consistently ranked as a top finance app on the Apple App Store. It benefits from having extremely low customers acquisition costs, especially compared to traditional financial institutions. At the moment, Block's shares trade 80% below their all-time high from 2021. Um, Investors now have the chance to buy the stock at the price sales multiple of 1.7, a huge discount to its historical average of 61. It's not a surprise that Kathy Wood's Art Invest has been consistently adding to its position this year. At the cheap valuation to Block's nearly $200 billion gross profit opportunity, the potential for strong returns are there. So it's quite obvious that it's got a bright future ahead, right? So what else we have? I'm gonna read one last article and then I'm done, okay? Hmm. Okay, Unity software. Okay, let's go see Unity software. Unity software. Second one are two undervalued tech stocks with catalysts that could increase their stock price or next year. Okay, it's a leading platform for 3D software development. Video game designers, graphic artists, filmmakers, industrial users rely on Unity's platform. It also offers solutions that help game companies monetize their games. Between 2018 and 2021, Unity's revenue grew nearly threefold, but slowing growth last year sent it stuck down to worrying territory. While the company's adjusted revenue fell 2% year over year in the first quarter, Unity's growth is far from over, reported $1.57 billion in trailing 12 months revenue through the first quarter. And while the market for 3D software is estimated at $29 billion just a few years ago, it's only going to grow larger. One catalyst for Unity over the next year is going to be improving profitability from its acquisition of IronSource, literally helping mobile app developers grow their business. The two companies are early in realizing expected bottom line benefits as they integrate. Unity reported a $32 million in adjusted EBITDA last quarter, up from a loss of $23 million a year ago. As Unity continues to integrate Iron Source, management is targeting $1 million in adjusted EBITDA by the end of 2024. The improvement already reported in the first quarter shows companies turning the corner on this objective. Oh. Okay, I'm almost done. Almost done. Okay, anyway, okay, let's get it. Let's put an end to it. This is it for today, and I'm gonna see you tomorrow. Okay, I'm gonna send a picture. Okay, bye bye.